All right, we're going to build a balance sheet next. I need to make one more addition. So on the cash flow statement, we've got add back depreciation and amortization. So here on the income statement, I took off depreciation and amortization. So I need to add it back. Okay, I need to add it back. So basically I do equals, and I add it back right there. Okay, whoop, that was crazy. I want to put it right there. Put it there, and I drag it over. Okay, so I added it back. And I'll put my underline back. All right, so depreciation and amortization is added back. My loan repayment is put on the cash flow statement. I need to create a balance sheet. Okay, so let's do that. Let's create a balance sheet. All right, balance sheets have three parts. Okay, they have assets, they have liabilities, and they have equity. Okay, assets, liabilities, and equity. Now, liabilities and equity are actually very, very similar. Okay, and that's a crazy thing to say, but it basically is. Liabilities is stuff you borrowed or you owe for some reason to somebody else, okay, and you have to pay it back, okay? Equity is stuff you got from somebody else and you kind of don't have to pay it back, but nevertheless, it also came in and you gave somebody a piece of paper. So you borrow $10,000 from somebody, you give them an IOU, you get $10,000 from somebody and you give them a stock certificate. It's kind of the same thing. Nevertheless, we place them differently because the liability guy actually has a claim on the assets. The equity guy does not. He gets everything left over after the assets are used to pay off the liabilities. Nevertheless, that's the way it is. Okay? Now, one thing that's really, really, really important. We're going to have a total assets line here. Okay? Total assets. We're going to have a bunch of stuff in here, right? Stuff. Okay? This stuff in here, okay? Stuff in here. And then we're gonna have liabilities here, loans and stuff here. Loans, and then we're gonna have equity down here. Now, what we're gonna end up with, I'm gonna tell you, equity plus liabilities has got to equal assets. That's our goal, okay? Equity plus liabilities equals assets. We can even put that right here. This is A, total liabilities is going to be B, total equity is going to be C, C plus B. C plus B is going to have to be A, okay? But regardless of all that, let's get through this, okay? Let's move this guy up here. Usually, assets are divided into short-term assets. And that's shit you can sell like immediately, like cash. You can always sell your cash. You can always give somebody will give you $10 for your $10. But there's also other short-term assets. There's, you know, a CD, a 3-month CD in your bank. It's worth basically whatever the balance is. You know, it's pretty close. All right. So anyway, short-term assets is cash, okay? Then we've got long-term assets. And you can get into medium-term assets and sort of whatever other bullshit. But the reality is, for a financial model, just do short and long. And you don't even really need that. You can just put it all under assets. But we'll do short and long for now. We're going to move this guy down. All right. Where does our cash come from, right? Where does our cash come from? Well, our cash comes from our cash flow statement. We already said that the change in cash is what should reflect our balance, our bank balance. So we're just going to grab it. We're just going to grab our change in cash, okay? There's our change in cash, okay? Now, our year 2 of our change in cash should really just be our year 1, right? Plus our year 2, right? I mean, that's what it should be. You gained X, your cash went up by X, and your cash went up by X again, right? And then the year 3 should be the same. Oop, I put these under the wrong thing. I mean, this shows us making a shitload of money. And interestingly enough, if you want to know how overblown the financial model in that document was for the state of Washington. We talked about the price of weed being $2,500. If you look at that article I pulled up really fast, the price of weed varied in 2015 between 2,000 and 1,000. 2017, the average was 1,700, but it averaged a low of 500, high of 26, right? And again, California, low of 500, high of 25. This model that we're building is way at the top of pricing. The reality is pricing for weed is $1,500 a pound, right? And it varies fucking dramatically. It's unbelievably volatile. And so this whole model actually, shit, at 1,500, you're like break even, right? And so if we go to our balance sheet, you know, we're like we got negative numbers there. We're short money. You know, the bank is calling us up and asking us where our money is. Anyway, but whatever. In a financial model, we'll make ourselves rich. So we'll put that at $2,000 at least, so we can have some money in this bank account. All right. So there's our short-term assets. Here's our long-term assets. Now, our long-term assets. Your long-term asset is what you paid for it minus its depreciation. So I know we've got a delivery vehicle. I know we've got greenhouse equipment. I know we've got a license, a startup license. Let's see what we've actually got here. Startup license and a Buddy's Weed Company. So these are all assets, man. So we'll stick them in here. We got our startup license and Buddy's Weed Co. All right, and so what we're going to do for these, let's shrink this a little bit. What we're going to do for these, we're going to put the year-end value. A balance sheet is a moment in time, okay? A cash flow statement and an income statement are periods of time, what you did over a month. The balance sheet is at the end of the month. It's a moment in time. You can calculate a balance sheet every day, every hour, every minute, once every 10 years. Doesn't matter, okay? It's all moment in time. It's a very, very important concept. I want you to remember that. It's in my book. Did I mention my book? All right, anyway, what the fuck? I'm sorry, I didn't mean to mention the book. It's not supposed to be a sales pitch. All right, let's go to the cash flow statement, and let's find the value of the delivery vehicle. Actually, I'm sorry, we're going to go to depreciation and amortization. Find the value of the delivery vehicle at the end of the time period. There's the delivery vehicle. Here's the greenhouse equipment, depreciation amortization schedule. Here's the startup license. Let's go to the startup license. Here is the Buddy's Weed Company. What's the value of Buddy's Weed Company? Okay, we amortize that, okay? Now, at the end of year 2 and year 3, we've got those, okay? So here's our assets, okay? Our total assets is the cash plus, is the cash plus, and I'll do a sum here of these guys. That's kind of what it is, right? There's my assets. There's my total assets, right? I could actually do this differently. I could do total long-term assets. Make this prettier. Let's put a line under that. We'll do a sum of these guys. And then the total assets can be the short-term assets plus the long-term assets. Oh, look, it's the same number. All right, there we go. And we'll do total long-term assets, bold. All right, now the liabilities, we got a loan, right? And what the loan is the outstanding loan, right? We got one outstanding loan. We got Buddy's Weed Co. loan. All right. And the outstanding balance at the end of the period was that. Okay. All right. Get rid of that. Now equity, interestingly enough, the way equity works on a balance sheet, we've got the equity we sold. We know we did 45,000 bucks there, right? Right. And then we've got something called retained earnings. Okay. Now, retained earnings is the net income that you've put on your income statement. Hold for a second. All right, I was just checking where I grabbed my my net income from my cash flow, and I'll show you a difference. So I got initial equity, and I'll move that number. Initial equity, and there's my initial equity. Okay. Now, period by period, this actually doesn't change. Okay. My initial equity is always my initial equity, just for the sake of making this visual. Right there, delete the row. Okay, now this is going to be my total equity, right? All right, so what you've got is something called retained earnings. Okay, now what is retained earnings? If a company makes money and doesn't pay it out in a dividend, it's retained earnings. It means the company's worth more. You know, you buy a hot dog for $2, you sell it for $3. You don't pay out the dollar, you put it in your pocket. That pocket, that's your retained earnings. Also happens to match your bank balance, that's your pocket, right? So very often the retained earnings is equal to, you know, the cash you've made or the income you've made. In this particular model, I used for net income, I put net income here. I didn't put net income after taxes. So on the balance sheet, I'm going to use net income for my retained earnings. Okay, so you go all the way over here to net income. Net income. Okay. That's my retained earnings for that period, okay? All right? Now, you have something called accumulated retained earnings, okay? So each year in this model, I build up retained earnings. That's because that's how you model it. It doesn't really work that way. You usually pay it out. You pay in dividends, you grow more, you make some decision, right? But that's what we're going to do. And here's my earnings for those 3 years. And then if we accumulate them, we add this guy to the one for that year, okay? And there's my accumulated retained earnings, all right? All right, now, dividends paid out. In this particular case, I've got none, all right? I can make these blue just to remind myself that I'm supposed to be doing that. All right? Now, let's just see for a second. Let's just see what our, let's move this down again. Let's make a total liabilities, total equity line. Jesus, total equity. God, I'm gonna need a fucking beer after this. All right. There's my total equity. All I did was add my initial equity and my accumulated retained earnings, okay? That's all I did, okay? I just added that there. Jesus. All right, let's clean this up a little bit, make it a little neater torpedo, make it visible, easy to read. All right, so now, what's my equity plus liabilities? Let's see if this works. Usually there's some fucking mistake and you gotta fix it and shit. There's my equity and liabilities, and there's my total assets. They're not equal, so we're gonna go figure out what's wrong. Okay, it'll take a moment. All right, let's do that because this is supposed to be equal to this. Okay, I'm sure we missed something somewhere. It happens all the time. Okay, one way to discover what you missed is you subtract them and see what's the difference here. See if we can figure it out. See if we can figure out what I missed. Somewhere I made a boo-boo, right? So I got 3,200, I got 6, I got 10. Let's see if we can find those numbers. It's 3245. Is it in the loan? Don't see that number there. Although actually, that's exactly twice the principal on that. I wonder if I'm missing a sign, right? Right, Buddy's Weed Company loan, total assets. We'll figure this out in a second, right? Let's move this guy down. Kind of bothers me sometimes when there's extra lines. Right. Let's, in fact, let's just get rid of that entirely. There we go. All right, we're going to figure this out. I think I got my loan signs screwed up somewhere. All right, so I found one mistake. So if you go over to my cash flow statement, cash from financing, repaying Buddy's weed loan, this is a negative. Buddy's weed loan is a payment out. So that's supposed to be a negative. It's supposed to reduce my cash from financing, not increase it. So that goes that way. And if I go back to my balance sheet, oh look, 100%, 100%. We're done. My assets, 102,856, is equal to my equities and liabilities. Everything balances. Everything balances. That is financial modeling orgasma awesomeness.